Now we'll have an exciting IFRS 17 panel discussion. Now I would like to pass the mic to Charles.
Hey, Robin, can you hear me okay?
Yep, all good.
Perfect. Okay. All right, so welcome everyone. Good afternoon. Welcome to the IFRS 9 and IFRS 17 session. My name is Charles. I'm one of the 3 panelists you have today. So maybe I'll quickly introduce myself. I'm the co-chair of the Singapore Actuarial Society IFRS 17 working group, and I'm a fully qualified actuary that's currently working for Great Eastern as their group actuarial lead in IFRS 17. Luckily, we're able to pick up 2 representations from IASB today to join me on the panel. So maybe I'll give them a quick introductions before I pass it over to Laura and Bruce. So quick introduction of Laura. So she joined IASB as a technical staff in 2017. She's a fully qualified chartered accountant, and she was previously working for Deloitte in the insurance sector prior to joining IASB. Then we have Bruce, which is a appointed member of IASB in October 2020. He's also a qualified chartered accountant, and he has 2 decades of technical accounting experience, as well as a preparer of IFRS financial statements. He joins the board from W Consulting, and he was previously working in Deloitte and Barclay Capitals. Yeah. So without further ado, I will pass my time to Bruce, which he will take you guys over IFRS 9 and sort of what the foundation is currently thinking about.
Thanks very much, Charles, and thanks to everybody for allowing us to be part of this conference. Good afternoon to you all from a cold and brisk London, as we're both joining you remotely. Just wanted to, obviously, I've introduced Laura, my colleague, who will be joining us today. And just a reminder that obviously the views that we're going to be expressing today are the views of Laura and myself, and not necessarily those of the ISB or the foundation. Most of the deliberations the board has are available on our IFRS news or on our website. So if you're wanting to see what we're discussing, you can have a look at those. Now, just by way of background, we're going to take a look at the 2 standards that were mentioned, obviously, in the post-implementation review. Take a look at IFRS 9 as well as IFRS 17 on insurance. But just to point out that the board has been very busy with many projects we've had on the go. Recently, we've just finished our agenda consultation, which is a consultation we put out every 5 odd years. What that does, in essence, is helps us set the agenda for what we're going to cover off in the for the next period. So that we've just finished working through at the moment, and hopefully next year we'll be able to get that out to you and let you know what the key things are. There's some really interesting topics that are coming up there, things like intangible assets, a lot around obviously sustainability, cryptocurrencies. So a lot of exciting projects that are on the probably going to hit our agenda once we make that decision in the short term. So keep an eye out for that. But let's get on to the issues of the day, and we're going to start off with taking a look at IFRS 9. Now, just by way of background, remember IFRS 9 was issued in July 2014, and this effectively was when the ISB completed its replacement of the old IAS 39. Now, IFRS 9 aimed to improve financial reporting for financial instruments effectively in 3 ways. The first one with a new classification and measurement approach. Secondly, with a forward-looking expected credit loss model to look at impairments. And of course, a hedge accounting model that better linked the economics of risk management with the accounting treatment we were looking at. Now, the standard became effective for most companies from 1 January 2018. But as I'm sure many of you were probably aware, there was an option for insurance companies to delay that implementation until they adopted IFRS 17. So I guess there's some pros and cons to that. I mean, obviously some of the cons are that you guys haven't been through that yet in terms of making comments on this. But I guess the good news is that there's been a lot of learning in the market, a lot of experience people have got. So hopefully you'll be able to kind of draw on that experience in terms of your implementations. Now, what we have done is this year, we've begun the post-implementation review of IFRS 9. Now, what exactly is a post-implementation review? Now, simply put, this is where we ask our stakeholders whether the standard is working as intended. So effectively, a post-implementation review is part of the board's due process, and it helps us assess the effects of the requirements on users of the financials, preparers, as well as auditors. In essence, it's our governance step to ensure that we achieve what we set out to achieve. Now, we carry out this process in a couple of phases. In the first stage of the post-implementation review, we go out and we have discussions with a broad range of stakeholders, we review academic research, and we look at various literature. From that, we consider the feedback from these activities and we decide what matters we should examine in a request for information, which is effectively what we've put out now. Now, the board uses this feedback to determine, for the RFI, to determine whether any action is required. And depending on the feedback we get from the RFI, we can decide to either take no action, so do nothing, or we could decide to amend IFRS 9, or even potentially amend other standards in projects we'll be doing on them. So there's no requirement that anything will change unless we get an overwhelming response that the standard is not working based on the criteria we've set. Now, the one thing I wanted to point out is we've done this PIR of IFRS 9 slightly differently. Normally, we ask about the whole standard. But in this one, we've divided the standard up into phases. In this first one, we're only looking at classification and measurement. Okay, so we're only looking at the first part of it. The big one, which I believe is going to be the bigger one, impairment, and of course, hedging, we'll take a look at later, probably starting in around 2022. Now, the reasons for breaking that up are firstly that we don't believe companies have had enough time to implement something like the impairment model. Moving to an ECL model was quite a big change for many companies. And just given what's happened with the COVID-19 crisis, companies have had to amend their models. Some have done things like overlays to try and adjust them for what's happened. We just think that there's been a massive kind of upheaval in the market. And to be good for, as companies are starting to hopefully move out of that and get back to some sort of normality, just to get another year's experience in it. So as I said, we will be doing these ones a bit later. Now, moving to the next slide, what in essence are we trying to assess in terms of this? Well, in particular, the board's aiming to answer the three main questions we put on there. Firstly, we need to assess whether the standard has improved financial reporting without disproportionate cost. So this is where, as I said, we ask, is the standard working as intended? So has it resolved the problems we designed it to address? Is the information resulting from the standard useful to users? And of course, have we responded to any changes in the market that have happened since we issued IFRS 9? We also need to see whether there are any significant unexpected effects. So, for example, have there been any changes that we didn't anticipate, or changes in the broader economic effects that hadn't anticipated, or whether there were any unexpected costs that preparers or auditors or even users found in using the information from there. And lastly, we also need to ask whether the requirements are capable of being applied consistently. So are we achieving that once people have started using it? Now, there is also a secondary objective, and that is, of course, we want to see whether there are lessons we can learn to improve financial reporting standard setting. So we ask about improvements to the process in terms of standard setting, as well as things like implementation and transition, so we can get some sort of update on those. Now, if we look at the next slide, this is in essence what we've asked for in this post-implementation review on IFRS 9. There's 7 hot topics and then another that we're looking at. Now, I'm not going to go into all of these in detail because I appreciate that you've had quite a long day out where you are and you've listened to a lot of good speakers, but just to kind of highlight some of the key things we've seen here that we want to go in. The first one, of course, even if we look at the first two, remember that we changed the classification models from IAS 39. Remember, IAS 39 had a whole different 4 categories, for example, for financial assets, and a lot of these didn't even make sense. I always like to cite available for sale assets, where we had this wonderful category called available for sale, but the assets you put in there didn't even have to be available for sale. Yet if you put something in held to maturity, you had to hold it to maturity, otherwise there were big penalties. And it just didn't make sense to people why things were going in one, why they were going in the other. So we did away with that, and IFRS 9 came up with a new approach, the business model approach. In essence, saying, why do you hold financial assets? And what we said is, the first and foremost, you ask yourself, what is the business model under which you hold these assets? And of course, what are the contractual cash flows that go behind that? And based on that, we gave you 3 simple categories you could put your assets into: fair value through profit and loss, fair value through other comprehensive income, or amortized cost. And we kept the name simple, which means it's actually worked a lot easier for people around the world. So we're asking, have these approaches worked? Are there challenges with things like the classification and the cash flow characteristics requirements? So those are the type of things we wanted to hear about. Remember, of course, we also put in a requirement effectively that you could do fair value in certain circumstances through other comprehensive income. That one has caused quite a bit of a challenge, because we're starting to see that that some people are saying, yes, we like that, but we don't like the fact that we put things into OCI and we can't recycle them. Well, how much of a challenge has that created? So we'd be interested in hearing from people. And then, of course, there are also all the new developing things. Probably one of the most emerging issues at the moment is all around the issue of sustainability linked features. So what do you do, for example, where you've got a loan that would normally be a standard vanilla loan, but for example, the interest rate is linked to ESG targets. So all those areas of sustainability, ESG, those things starting to impact on simple financial instruments. And the question's now whether those should be fair value, amortized cost. And what we're really asking is, does IFRS 9 create a platform under which you believe you can actually get the answer? Now, those are some of the hot topics we've listed, but remember, there is a last one that says, are there any other matters? So if there are things that you're finding in that as you do your implementations, you're going, oh, this doesn't really work, let us know. The one thing I will say to people is there are very few times you get an opportunity to change a standard for things that don't work. If you didn't comment when we issued IFRS 9 back in 2014, this is your chance now. Let us know if the standard's working, and at least from that point of view, we can then take that forward and hopefully make the changes required. So kind of that's where we are. As I said, the PIR is open at the moment until about the 28th of January. So you've still got time to comment. I do think it's important. And I appreciate that many of you maybe haven't got the years of implementation of IFRS 9 because you're only going through it now. But as I said, if you've been going through your IFRS 9 implementation and you've been seeing challenges with classification measurement, please do let us know. This is an opportunity for us to kind of take that forward. I also think that you'll have chance to comment on the other PIRs starting later next year or even into 2023 on things like the impairment model. So there are going to be opportunities to comment on those later aspects when we do those next year. With that, that's effectively a summary of what we're doing on the IFRS 9 side. And what I'm going to do then is I'm going to hand over to Laura, who's going to take us through the issues on IFRS 17. Charles, if I'm right, we're going to leave questions to the end, aren't we?
Yes, but perhaps we just ask one first, just in case we
sure.
With audience is sort of connectivity, basically. So one of the questions we got, since you mentioned about the post-implementation review, right, was that a lot of insurers hasn't actually done much yet for IFRS 9. So from that perspective, would there be another channel to sort of provide feedback when they actually are more informed? Like what you said, other issues perhaps they haven't foreseen when they actually look deeper into the standards. So what is the game plan from the foundation's end?
So the answer is we're always very keen to hear. I mean, we always want to hear about if there are challenges with the standard. And I think it's important to point out that it's a very good question, because it's important to point out that even if you missed the PIR now, we're not saying, well, that's IFRS 9, deal with it for the next 10 years. If you find there's a major issue and you can't address it and there are challenges, let us know. It's important for us to hear that. And either if it's an interpretive issue, we can put it into the IFRIC, the interpretations body, or if there's an issue, and we've had it before, where somebody's looked at something and gone, wow, there's a gap in the standard. We really do have a challenge with that. What we could then do is put that in and put that through as a narrow scope amendment or an amendment to the standard. So we don't like to do a lot of that because obviously it starts impacting the stability of the standard. But yes, if there's a challenge somebody comes up that maybe we hadn't foreseen, all you need to do is let us know and we'll happily discuss it with you and see if it's something that's widespread and we need to take on.
Got it. Thank you, Bruce. I think that's good to hear. As long as the foundations keep their ear open, right? Whenever we discover something, we'll try to find a method to feedback to you guys. Yeah. Thank you. Okay. So Laura, so pass the mic to you. We talk a bit about IFRS 17 and sort of the foundation side of things. Yeah.
Great. That sounds good. Thanks, Bruce. Thanks, Charles. Yes, so my plan was, I was thinking I'll spend a bit of time, just a bit of a reminder on where we're at on the implementation timeline on my favorite standard, IFRS 17. And then after that, I thought I'd just spend a little bit of time talking to you guys about a small amendment we're doing at the moment. It's a very narrow scope amendment to transition, but it's quite technical, so I'll probably spend a while talking about it. But before I get there, let's look where we're at. So can you believe it? It's been more than 4 years since IFRS 17 was issued. So that was May 2017 that happened. And we've got less than 2 years to go until the effective date. And then when you think about comparatives, we're really close. So in those earlier stages of implementation, you might remember the board embarked on quite a significant implementation support activities. So we were attending a lot of outreach meetings. We were producing a lot of educational materials. You might have seen our webcast series, articles. We even had a reinsurance pocket guide. And one of the biggest things we did as well is we established our IFRS 17 transition resource group. So that group was like a public group that met a few times a year across 2018 and 2019. And it was made up of a mix, importantly, of accountants and actuaries, both specializing in insurance. And they were really sort of, top of their game around the world. In that time that the TRG met up in those first couple of years, they actually discussed more than 120 implementation questions submitted. They got through a huge amount of questions. One thing I think that is important to note, though, actually, is one of the sort of conditions of TRG questions is they didn't discuss anything that was actuarial in nature. So it wasn't the TRG's job to go in and make actuarial judgments, for example. So yeah, there was lots and lots going on in those years. And sort of as we got towards the end of that very busy period, around in 2019, the board also decided it was going to issue some amendments to the standard. The IFRS 17 is such a big standard, it's complicated, and it's such a huge change for insurers compared to what they were doing before with IFRS 4. So when the board had been supporting for about a year or two, hearing loads of feedback from everyone as they were working through their implementation projects, it decided that actually it could issue a package of targeted amendments just to help insurers get over the line. So a few amendments that would really help them move over that hurdle and better explain their IFRS 17 results when they get there. So those amendments were issued in June 2020. Since that happened, we've slowed down a little bit from our side. So I think really the board stepped back a little bit, kind of just to let companies get on with their implementation, work through it without having us interrupting that for them. So we really see this as an advanced stage of implementation right now. And we can see that industry are really working together through some of the more complex and detailed issues at this stage. And from an ISB perspective and a staff perspective, we've continued with interest implementation. People have been giving us updates on sort of what they're working on. And we're monitoring that, but we're really doing that from the background at the moment because we don't want to disrupt what you guys are doing. And then what we're going to expect to see as we're moving forward now with IFRS 17, from our side, it will become a bit of our business as usual, if you like. So we have a sort of wider implementation support program for all our standards, and IFRS 17 will start sitting in there with all our other standards. So for example, one thing we have to help with standards is our IFRS interpretations committee that discuss application questions on any standard. And, I expect that as we move on in time, some IFRS 17 questions are going to start being discussed by that committee. Other than that, so we've got our transition issue that I wanted to talk to you guys about. So there is one specific issue that was raised to the board earlier this year, and the board decided that it was justified to make an amendment, and we're just in the process of finishing that now. So let me share with you guys what that is. So the amendment that we're making right now, it relates only to transition, so only the first year of financial statements for IFRS 17. And it relates to applying at the same time 17 and 9. And it relates very specifically just to the comparatives that insurers are going to present in that very first year. And the issue essentially is that IFRS 17 and IFRS 9, they have different transition requirements. They were developed at different times, and they were developed with different costs and benefits in mind. And the IFRS 9 transition requirements don't start essentially at the same date as the IFRS 17 ones. So IFRS 17 is applied from the transition date. So that's the beginning of the comparative period. So if you're doing IFRS 17 from 2023, the transition requirements applied from the beginning of 2022. IFRS 9, on the other hand, applies from the date of initial application. So for 2023, those requirements applied at the 1st of January 2023, if that's the beginning of your reporting year. Companies that, when they do apply IFRS 9, they can restate those comparatives. for IFRS 9, but they cannot do that for any assets that were derecognized in that prior year. So in our example here, if there are assets derecognized in 2022, those can't be restated for IFRS 9 because quite simply, they don't exist when IFRS 9 is first applied. So earlier this year, some insurers said that actually for them, this causes quite a big issue. And it really depends what their existing accounting is now under IAS 39. But some insurers said to the board that actually these sort of differences that you can see on the slides cause some quite significant accounting mismatches for them, only in these comparatives they're going to present in the first year. So I think an example of companies that might be most affected would be companies that have a lot of assets, for example, at amortized costs at the moment, and that's fine against the IFRS 4 insurance contract liabilities because they're not at a current value. But when it comes to first application of IFRS 17, those comparatives are going to be restated for IFRS 17. So they're going to be brought up to a current value. They would like to use a more current value for their assets as well. So rather than using amortized cost, ideally they would use the fair value option in IFRS 9 and show those comparative assets at fair value. And they can't do that for these derecognized assets. So they're saying they might get a big accounting mismatch. For example, IFRS 17, current information, IAS 39, amortized cost information. Saying that, this isn't a problem for everyone. Some insurers already have most of their assets at fair value under IAS 39 anyway, so they're not going to see this significant accounting mismatch in their comparatives. So really the aim of putting an amendment through here is just to help those insurers that will have the mismatch, give them something that they can use, but without causing any disruption or any changes for anybody else. So how does it work? What we're introducing, we're calling it a classification overlay. It's a transition option targeted at the issue only for these comparatives. And essentially, what someone will do using this overlay is they will present those comparatives in the first year as if IFRS 9 had applied. So they'll use their kind of preliminary assessments that they've prepared as they're building up to IFRS 9 to come up with an expectation of what would you classify that asset as under IFRS 9 if you weren't going to sell it this year? What would you be planning to classify it as? And you would present your comparatives as if that had applied. Saying that, to do this, an insurer doesn't have to apply the IFRS 9 ECL impairment requirements. So the board realized that some insurers might like to do IFRS 9 impairment requirements for those comparatives. So it's like IFRS 9 applied all the way from the transition date, while other insurers might not yet be ready for that. They might need this classification overlay to fix some accounting mismatches to get them to fair value, but they might not be ready to do the impairment requirements just for the 2022 comparatives. And the board said, that's okay. This overlay can still help you to give better comparatives, even if you're not doing the impairment requirements. So there is no need to do those. From a disclosure perspective, we're not adding significant disclosures for someone who's doing this because ultimately they're improving their comparatives. They're bringing them closer to IFRS 9 than they would be otherwise. But we're just requiring some descriptions. So we want someone to describe if they've used it, how they've used it, what they've done from an impairment perspective. But we're not requiring that insurers single out those exact figures and give any kind of quantitative disclosures. And then without going into too much detail on the scope, essentially this will apply, insurers that are applying IFRS 9 for the first time, they could apply this to any of their financial assets, even the ones they have that aren't connected necessarily to their insurance activities. And then the last thing I've got just to point out is there is a little extension on this amendment for those insurers that have already applied IFRS 9. The accounting mismatch issue is mainly for guys that haven't applied IFRS 9 yet. They apply 17 and 9 at the same time. But there are some insurers that have already applied IFRS 9, either voluntarily or because they didn't meet the temporary exemption. And they might even still face this issue for their derecognized assets, because they might have met amortized cost under IFRS 9, and they still want to use a fair value option to get there, but they can't use the fair value option for the comparatives. So there is a little extension. It's not just for guys that haven't applied IFRS 9 yet. It can be applied for those guys that have already applied IFRS 9 for their derecognized assets. Yeah, so that's that really. Sorry, I know it's a very technical one, this. It's very small, but very technical, so it takes a while to describe. I hope I did it justice, just giving you guys an overview and that was helpful. But I will stop there, and I don't know if we want to take questions now, Charles, or if we want to wait till after your IFRS 17 part as well.
I think maybe we just ask a few questions first. And thank you, Laura. That was very useful. I think our companies are, my employer, it's one of the companies that actually applied 9 early. So you just mentioned something about how we might need to reassess it, knowing that the amendment that just applied to people who haven't applied it. But okay, that's great news. Maybe let me get the cheeky question out of the way, because when I'm gathering feedback, right, the one cheeky question I got was, is there still a possibility of the effective date being delayed again?
No, that's fine. It is, yeah, that cheeky question that we hear as well. I mean, obviously, I can't speak for the board, but I think it is extremely unlikely. I do not think the effective date would be delayed at this point. There would have to be something really significant from the ISB perspective to delay the effective date of the standard. And saying that, it's interesting because we do hear that from some people, and it's a good question given it was delayed before. It's already been delayed by 2 years, and it was already given quite a long implementation period. What we've actually been starting to hear since the amendments were issued and we put the 2-year delay through, lots of insurers have actually come out and said, please don't delay again. You know, I know there'll be some people that would love a longer delay, but actually, surprisingly, more and more people have come out and said, please don't delay again, because you know, it means these projects go on longer and longer, and I think people kind of want to get it over with now, which I can understand. So yeah, we started to hear more please don't delay again than please do delay again.
Yeah, makes sense. I think from an implementer's perspective, right, my budgeting and finance committee will thank you for answering it that way. But I'm sure some of the late implementers are a bit sad in that they won't have more time now, knowing that it's unlikely to move unless something significant comes up. Okay. The other questions I also got is related to your amendment. You know, ISB is making amendments so close to the effective date, right? So would there be more amendments coming down the line, or it's kind of it, because we're hoping that there will not be any more adjustment from our end as well. So what is your take on that?
So similarly, I think it's extremely unlikely, and to be honest, in terms of the due process, it would be almost impossible to put anything through now, because anything we do goes through a very thorough due process. Rightly, we have to publicly consult on it, we put drafts out, we need time to finalize properly, and then also we need to give jurisdictions fair time for their local standard setters and lawmakers to endorse it and put it into law. So I think, you know, it would be impossible really to put anything else through, but it'd be extremely unlikely anyway. I think after the board issued the sort of package of 2020 amendments, you know, it said it's very, very unlikely we're going to do anything at this stage. It's not fair for people. You know, you need to just let them get on with a stable platform to get ready for their implementation rather than keep changing things.
Right.
But with this particular little amendment, it's just transition, it's just comparative, and it's optional, and it doesn't affect anything else. So in that light, the board thought it was, you know, it was worth doing, because it will really help some people to give a better picture, you know, more understandable picture in that first year. And we decided, you know, the board decided it's not going to disrupt implementation, given that it's just comparative, just optional, just 1 year. So it's a bit of an unusual one. I think it's very unlikely that the board would do anything else.
Thank you. Yeah, that makes sense as well. And on the comparative, the word on the street when it was first discussed was also that, oh, it makes sense for the board to move forward with that. So I think everyone's kind of glad that actually happened. So, okay, great. So again, just to remind all the audience, if you guys have any questions, I'm going to go through my sections. There's still a chance to ask Laura and Bruce questions, so please type them in the chat box and try to collate them and ask that question. All right, so let me just quickly share a screen on this. Okay. All right, so when we were putting together the slides, I'm talking to Bruce and Laura. Initially, I wanted to minimize my section as much as possible, just because it's a rare opportunity. You know, you get to ask ISB representative questions. After a while, when I collated all the questions, I realized that majority of the questions are about technical issues, and it's not fair for them to comment on that because they're supposed to be unbiased in this situation. So at the end of the day, I felt like it was more appropriate as an implementer to comment on some of the issues, especially local issues as well. So I'm going to put it out there and saying that these 3 topics I'm going to go over is mainly contributions from individual actuaries. Doesn't represent ISB, doesn't represent the Singapore Actuarial Society either, but it sort of gives pointers to what people can consider in implementing sort of your policies in your respective companies and whatnot. So before I go to those 3 issues, just a shameless plug. Singapore side, similar to UK and everywhere else, with our own sort of like working group. So if you guys are interested in learning more implementation issues beyond sort of the 3 topics that is highly discussed right now, please you know, message me, message Harry, which is the co-chair, just join the discussions. I would believe that more people join, the more beneficial it is for everyone's in the group, and actually save on perhaps some of the interpretation issues that will be very quickly ruled out because no one really interpreted that way. Right, so on the group, we meet once every 2 to 3 months, 1 to 2 months. And then beyond that, so far, we've already produced 14 papers covering a variety of topics. So if anyone's interested, please go online, take a look at the link above. You'll be able to see sort of the result of some of our discussions. Yeah. So let me skip over the disclaimers. All right, so in comments I've collated from the industry in Singapore side, there's 3 hot topics that's floating around right now. Topic 1, which will be about VFA eligibility. From the standards perspective, spoke about contract level assessments and the 3 criteria you're supposed to meet. It talks about the underlying items, the relationship with the payout, as well as what is identifiable. In the industry observations we have so far in the working group discussions, what we have noticed is that there's a variety of test methodology exists and different stage of the product cycle. And most of the companies said that if we apply a contract level assessment, it will likely cause common builds of common IL products and participating products in Singapore to fail, which basically means that it's likely that one product will be split into 2 measurement models, and that increase the complexity of the calculation as well as the predictableness of the financials. Now, what the working group has sort of discussed was that perhaps on participating contracts, there are grounds for discussing your auditors on assessing on a higher level, especially when there are mutualization cash flows and their interrelationship on this. Particularly, this point was brought up by, I think, the UK endorsement board as well, to what is appropriate method to treat these contract with mutualization cash flows. At that point, people need to assess what the fact patterns are of your contracts. Then the 2 other points that was brought up was 1, you can refine your test methodology further to prevent such a case from happening. Or obviously, number 3, you accept it as a reality and you move on. Again, these are not sort of binding in any shape or form or guidance, whatever, but just discussion points associated with what the industry practitioners sort of brought up as actuaries interpreting the standards. Yep. And then topic 2 and topic 3 are sort of unique based on the territories we actually currently operate in. So in IFRS 17, it sort of talks about how if sort of basic and riders combined to achieve overall commercial effect, you should be looking at them as a single contract. But we know that from the regulation, local regulation today, that is not a requirement. So what we've seen in the industry today is that on highly interrelated components, like based off the basic plan and the riders, we all believe in the industry that it should be measured as a single contract. But on contract that's not highly interrelated, the companies actually split in terms of what is the right method to treat them. So the consideration here is that what are the fact patterns in the legal form of the contracts is something that we urge people to look into. On top of that, obviously the financial aspect, like with combining your contracts versus measuring separately, created vastly different results. That might be the case on point 3, where it mentions the contract boundary might be different if you have a basic plan that is, I don't know, 100 years long and a rider that's 1 year long. When you measure them separately or measure them combined, then you actually generate a very different result. So those are all considerations we urge people to take a look at when you guys are making that decision in Singapore for your company. Then on topic 3 is sort of like an extension of topic 2. In our local regulations, there are obviously restrictions towards how you can charge some of the expenses to policyholders. If you think about power policies, there are specific guidance on that. Again, on the industry observations, we largely agree that what is chargeable today remains chargeable and attributable under IFRS 17. But from the perspective of those expenses that is sort of restricted but being charged to policyholders, the industry is also split right now as to whether or not they deem it as attributable or not attributable. From the standard perspective, there's very clear guidance towards what is deemed attributable and not attributable. But from the interpretations of this combined with the local regulations, companies are sort of split in terms of which way it should go. So the consideration here is that on the treatment of these restricted expenses, if you do deem it attributable, what will be the appropriate treatment in your financial statements, and whether or not it actually contribute towards part of your acquisition costs, and would it actually means that you must have 2 expense bases in order to achieve that. So overall, I think these 3 topics were sort of like the hot topics that we've seen asked and for us to comment on. Again, in no shape or form, this will form sort of how people should implement them. More so just considerations in terms of how everyone should shape their policy and consider some of these items in here. Maybe that will help towards what you should be implementing and sort of discussion with your auditors. Yeah. Okay, so we leave a little bit of time for questions. Let me just quickly see. So I believe this question is likely for Bruce. So the question's asked, from your observation or feel, do you expect material changes in the net tangible asset of insurer with the implementation of IFRS 17? And how do you think the market is going to react to this?
Sure, it's a tough one, Charles. I mean, I guess from my experience, having seen the implementation just generally of standards, I mean, the nature of any implementation depends, of course, on the type of instruments any company is holding, on the extent to which the standard amends what they do, and of course, I think one thing with the liabilities obviously coming out of IFRS 17 are going to be how different was the treatment people were applying before IFRS 17, and how different the result will be. So, if you had practices that were very similar to what we've proposed in we're requiring in IFRS 17, obviously it's not going to be that much of this. Whereas if it's a large difference, then you will have. Now, I'm not very knowledgeable on what you guys were applying in Singapore, so I won't pretend to comment on that. But I think the reality is that the one nice thing about these types of standards, if I look at IFRS 9 or IFRS 17, is it brings in consistency, which means everybody's going to be applying it the same way. So if there are large movements in the market, the large movements will impact all companies in that market. It won't just be one person or the other, unless they're doing something very different to everybody else. And I think one of the things we try to do in any of the standards, and we mentioned earlier, is one of the objectives of the PIR is look for that consistency. So if we can get companies to apply consistently, then what we generally find is users can get the right information. And if they feel they want to adjust, can make those adjustments. So I'm not sure how big the changes will be for Singapore insurance companies. I'll be honest, it's not something I've got a lot of data on. But I think I wouldn't be too worried. If you find you've got big changes as a result of implementation, chances are so will everybody else in the market. And I think a lot of it's just going to be around education of the users to help them understand why those changes have come about.
Yeah, makes sense. Thank you, Bruce. Let me just see if there's any more questions. I think that might be it. Again, Bruce and Laura, thank you so much for joining us in this conference. Appreciate your time. Robin, I think this wraps our presentation. I'll give the time back to you. Thank you so much again.